Hello and welcome back to Lipper's Fund Flows Insight. I'm Matthew Lemieux. We're going to be reviewing fund flows for mutual funds and ETFs for the week ending October 10th. And as we've seen for this weekend and Wednesday, it was another kind of slow, tough, week in the markets. We saw the S&P and Dow Jones both down around 1.3%. But the bigger story was technology, with NASDAQ down 2.7%. I think a lot of this really came on the thoughts that we've seen some outlooks, especially from the IMF recently come out, that supported the thought that the global growth outlook is less than it's going to. They basically downgraded both 2012 and 2013 on the global growth. One good thing of that is they actually increased the thoughts on the United States part of that. So there was some good news, but overall I think investors were somewhat concerned, especially when it came to technology, as we'll talk about a little bit more, as well as we're coming into an earnings season where I think that some of the analyst expectations are a little bit lower than we've seen even over the last few months. So let's take a look and see how this information really traded out for investor sentiment and mutual fund flows. If we look at mutual funds by themselves, ex ETFs, we see overall about $1.7 billion coming into the group for the week. Of that, $1.1 billion out of equity. So equity mutual funds continue to struggle, but taxable bond funds pulled in about $2.4 billion to kind of overcome that loss. Looking at municipal debt funds, they saw about $851 million come in, so about $0.9 billion. And then money market funds push out about $500 million. So a lot of the similar things that we've been seeing, maybe a little bit slower pace. Again, outflows from equity mutual funds, inflows into taxable bond funds, maybe just not the same magnitude as we've seen before. So let's go over and look at equity specifically. As I'd mentioned before, another week of outflows, $1.1 billion going out of the group. This is actually the 9th consecutive week of that group with outflows. And if you look at the 4-week moving average, we're sitting somewhere around $1.7 billion per week, and we really haven't been to this level since basically the beginning of the year, first week of January. So investors are still feeling very confident about taking money out of equity mutual funds. As we spoke back in the past, it could be a shift into ETFs. It could just be a little bit of taking risk off that they came in a couple weeks ago with. Overall, though, basically the sentiment is that domestic equity funds really took the brunt of it, $1.5 billion, and non-domestic actually pulling in about $402 million. So let's go over and look at the ETF side again, because there's usually been a tale of two cities between these two groups, and once again that is true. If you look at equity ETF inflows, $2.1 billion. So this is a pretty stark comparison. So it seems like investors are continuing to go towards ETFs as compared to mutual funds. But if you look at the numbers a little closer, we actually see a surprise here. If you look at SPY and PowerShares QQQ, you see about $1.1 billion out. So really investors weren't feeling very sanguine about the broader markets like we've seen in the past. In actuality, a lot of the inflows coming in this group had to go with GLD, brought in $940 million. And if you look at iShares Gold Trust, IAU, it brought in about $219 million. So there was heavy inflows, most half of it into gold funds. But then we also saw some money going into energy. The Spider Select XLE saw about $594 million, which again is not that surprising. We've seen upward pressure on oil prices. And then we saw some flows going into some Germany and Hong Kong, more institutional moves. Not a lot of push behind that since those groups actually saw negative performance for the week. So overall equity, if you look at ETFs and mutual funds, in the positive, but mutual funds continue to struggle. The next group we'll go to is taxable bond funds. As I mentioned before, we saw $2.4 billion go into this group. It is somewhat slower than we've seen in the past. That said, 18 consecutive weeks of inflows. If you look at the 4-week moving average for taxable bond funds, we're sitting in a comfortable range about $3 billion per week. But again, like I said, $2.4 billion, kind of the lower end that we've seen over the last run. If you actually look at that, it's basically back to since September when we saw the numbers down this low. If you look at the underlying data, really investors were flocking to investment grade, higher quality type products. $892 million into that group. Also, mortgages continued to get a lot of attention, $637 million in that. If you looked at the actual underlying constituents of mortgages, a lot of that interest, about $500 million, actually going into the double line total return fund. So really a specific fund kind of bolstering that group up. And the last international global debt with $240 million coming in. Again, if we look at the ETF side, we do see a little bit of a different story here. On the fixed income or taxable fixed income ETF side, we saw actually about $121 million going out. So relatively, that's really flat. This is the first week of outflows in 5 weeks for that group. And if you look at this, one of the interesting movements was in TIP, or in the Treasury Inflated Protected Security product. And really what it kind of was is I think a lot of investors really kind of jumped in and overbought into this area after we had the announcement of the quantitative easing from both the European Central Bank and the Fed. And now we kind of see that that is really the short-term inflation risks are kind of dropping a little bit, so investors are kind of taking some money back out of that group. Overall, though, we did see some inflows into, or some outflows into high yield. So again, on the ETF side, some investors, really kind of continuing to pull money out of high yield. Kind of an opposite of what we've seen so far, but still, if you look at the high yield group as a whole, both mutual funds and ETF, we're still looking at record flows so far this year, somewhere in the area about $34 billion. The third group we're going to look at is municipal debt funds. Again, this has been a very strong group that has really kept the attention of investors for quite some time. And in fact, we saw about $900 million come back into this group this week, or come into this group this week, and it's its 26th consecutive week of inflows. It's also the highest amount of inflows we've seen since August 15th. So investors kind of, the flows kind of simmered out a little bit more down to around the 400, 500 million a week range. Once again, jumped up back toward $1 billion. And again, I think it's investors really looking at the yield, not in absolute terms, but maybe as the tax advantage of those yields compared to their taxable counterparts. If we looked at the underlying fund, National Muni pulled in about 722, and of that, there was still some appetite for high yield Muni, 155 million in for that group. So we get to our last group, which is money market funds, usually kind of the least impressive or interesting part. We saw about $500 million go out of this group this week, which is really quite quiet for money market funds. But it's really interesting when you look at the split here. If you look at institutions pulled in about $3.2 billion into money market, while retail investors pulled out about 3.7, which may be kind of a sign that, hey, even though we had these positive feelings after the announcements of the QE, the quantitative easing, the outlook was good, it seems like institutional has kind of been up and down on that news, but maybe retail investors, that was kind of the turning point for them to kind of then keep going back into risk we've seen over the last couple of weeks. And this week, $3.7 billion money market, they're probably putting that money to work somewhere else. So it is a pretty good thing for retail investors, we hope, as if the markets continue to do quite well. So going forward, we're really going to have to turn our attention, I think, to the earnings season. I mean, it's still quite early right now. Alcoa did come out originally kick off the earnings season, and even though they beat estimates, their earnings were really quite low compared to year over year, somewhere, I believe, about 2% below last year. So even though they beat earnings, still the outlook on revenue wasn't that great. And then going forward, I think there is some concerns from analysts on what we're going to see in what's to come. Overall, we saw basically the thought is that the earnings are going to be lower than they are, actually probably the lowest of the S&P 500 since they were Q3 2009. So I think once we get all the earnings reports in, we'll probably have a clearer picture of really how the markets are going to take us through the end of the year. And then, of course, at the end of the year, what's really waiting for a lot of investors, specifically in the U.S. and globally, is this fiscal cliff that Congress needs to take care of. So we'll have to kind of keep an eye on earnings, see if they come through as well as they want. The earnings surprise average rate based on Thomson Reuters estimates is somewhere around 64%. This year, we've heard that from some of the preseason reports that maybe we're looking more in the 50-55%, so we'll see how that goes. But either way, you can find a little bit more information about the flows we've been talking about at our website at www.uslipperfundflows.com. And if you need a little bit more information, you can come back and join us next week. So once again, my name is Matthew Lemieux, and thank you for joining us at Lipper's Fund Flows Insight.